All right, guys, we are wrapping up the last sections in chapter 11. We're going to take a look at the very last depreciation method, and then I'm going to also introduce you to what amortization is. So, with that being said, the last one, the last depreciation method is going to be the easiest one you will learn, okay? It's called straight line, okay? Once again, we have the 5 components that are necessary to keep track or in order for you to do depreciation, right? You need the cost of the asset. This time you're going to be needing the estimated useful life, okay? So in this case, the life of the asset matters. It's very time sensitive, okay? Just like double declining, all right? And then the second thing here is that you will need to have third thing you need to have is a salvage value or a residual value. The date that you place it into service is also very, very important because, once again, we care when you place into service and we care how old the asset is. If it's only 5 months, you can't depreciate for the whole year. You have to consider how much it's going to cost you, or in this case, how old the asset is. In that aspect, we have to kind of figure out how much is that going to cost you. Okay, and lastly, you need to know the depreciation method, which in this case, we're on the 3rd section, so we're going to be learning the straight line. Okay, now this is the one that most companies use, and it is 100% approved by the IRS because this ensures and guarantees that you will meet the end of your goal, which if you have a salvage value, then you'll absolutely get there. And the other one is that for IRS, if you have no salvage value, you will 100% get to 0 using straight line. Okay. Now let's talk about what straight line and how we use it. So once again, this is the most easiest one because it's pretty clear. It's just like a graph, right? If I say a straight line, that's exactly what I'm going to be thinking. It's going to be a constant number, meaning there's no fluctuations. It's literally a straight line. Now, when I say straight line, what I mean by this is that when we actually think about how we depreciate it and why we depreciate it, you're basically going to take the asset, you're going to determine the cost of it, right? And basically, you're going to spread the cost evenly amongst its useful life, evenly. So that means every year, you will depreciate the same exact number. So with that being said, knowing that key factor, once you solve for one of the depreciation expenses, you can automatically fill out the rest because it's a straight line. You're going to be constantly depreciating the asset for the same exact amount every year, okay? But that's talking in terms of years. Of course, if you have the idea where you place the asset into service at the end of the year, then you're going to have to make adjustments there. But the idea is that you're spreading the asset cost amongst its estimated useful life evenly. Boom. All right. So here, let's take a look at a few components here for the difference between some of the formulas. So once again, we got to take a look at units of production. We got to also take a look at double declining. Now, what straight line is essentially it's a mix between the two. So that's why I said that for this kind of depreciation, you need to be aware and make sure that you are doing this correctly, because when we introduce all 3 methods, one method is a combination of both of them. So you want to be very careful on which method that you're using and making sure that you have the appropriate tables or the appropriate formulas. So that's why I recommend you, if you are for the exam, to have the formula sheets next to you when you're doing this because, again, I don't expect you to memorize this, okay? So the first one is depreciation basis, which is going to be the cost of the asset minus salvage value. Where have we seen this before? Units of production is the very same thing. You're going to determine the cost of the asset minus the salvage value, okay? Because that's going to give you the amount of the total cost that you can depreciate up to, okay? Then the next thing is going to be depreciation rate. This time, it's only 1 divided by the estimated useful life, and that's it, okay? Where have we seen this before? Double declining. But this time, instead of multiplying it by 2, because we realize that for double declining, you're essentially depreciating it twice as much. In this case, I'm only depreciating it once. So in this case, my rate is going to be 1 over the estimated useful life. Now, if you think about this, right, 1 out of its estimated useful life can pretty much determine that if the asset can last 5 years, then every year, how much do you need to depreciate it to end up on the 5th year to equal the total asset cost? That's exactly what I mean. We're spreading the cost amongst evenly amongst its total estimated useful life. You're spreading the cost evenly every year to depreciate it in the same value every year, and you're going to decrease it till it either hits your salvage value or it is 0. So in this case, the depreciation rate for this one is 1 over the estimated useful life. Okay? And then this one, right, the depreciation expense is straightforward. It's your depreciation basis times rate. Basis times rate. So we see this kind of common formula that's kind of the same between the two methods that we looked at, right? This one is more for, it is exactly identical to double declining, right? You always take the basis times the rate, and you will get your depreciation expense. Okay? And then last but not least, the last two formulas, your accumulated depreciation and your book value, these two formulas are the same throughout every single depreciation method, okay? So here, once again, it's a combination between the units of production and the double declining method, right? We see similarities. Okay? So let's go ahead and dive right into the example here. So in this case, the question here is to record the depreciation for the first year. Now let's go ahead and solve this table. So if I bought a machine, right, for $15,000, its salvage value is $2,500. Its estimated useful life is 5 years. It can produce up to a total of 10,000 units, and the date that we place it into service is as of January 1st. Now, assuming that we're depreciating at the end of the year, right? My depreciation happens December 31st. So in this case, let's solve for each component. First one, here is my depreciation basis. So what is my depreciation basis for this example?
1250.
1250. Correct, right? The asset cost is 15 minus the salvage is 2,500, and you should get 12,500. Okay? What's going to be my depreciation rate?
1 divided by 5, which is 20%.
Correct. 1 divided by 5, which is 20%. Okay? So therefore, what's going to be my depreciation expense?
2,500.
2,500. Yes, because we take my basis of 12,500. We multiply it by 20%. So therefore, it's going to be 2,500. Okay? What's my accumulated depreciation for year 1?
It will remain the same because you just bought the machine.
Good. And then last but not least, what's my book value going to be?
10,000.
10. Nope, not 10,000.
12,500.
Yes,
So I'm
yeah.
subtracting my, oh, yeah, because
we
we already did depreciation. Okay.
Yeah, okay, good. So it is 12,500 because we're taking the asset cost, not the depreciation basis. Okay. So in this case, the asset cost is 15 minus the 2,500. Therefore, we have 12,500. Okay. So let's go ahead and solve for year 2.
The base is still going to be 1250 because that's the previous year's book value. The rate's going to remain at 20.
Okay, so Felipe, your depreciation basis is not going to be your book value.
Oh, okay.
It's going to be the cost of the asset minus salvage.
So it would still be the same, right?
Yeah, it remains the same.
Correct.
Okay.
Okay, and we realize that the rate's going to be the same as well. What else is going to be the same?
The depreciation expense.
That's correct.
Oh, okay.
Okay, so now you're noticing a trend. So what's going to happen for year 3?
It's going to remain the same.
They're all going to remain the same. So that's the easiest thing that I want you to know is straight line. It's exactly why it's so popular, because you just need to do one or two calculations and you can figure out the rest. Okay, so that means here we notice that the first 3 columns, your basis, your rate, and your expense, are all going to be identical. Okay. And therefore, once we do that, right, once we notice that that's going to happen, we're going to notice that at the end of the useful life of the asset, right, 5 years, it's going to be, the accumulated depreciation is going to be equal to your depreciation basis. And last but not least, your book value is going to equal your salvage value. So once again, easy. Okay. Any questions?
Nope.
Right? Pretty straightforward, right? Haha, get it? Okay, sorry. All right, anyways. Let's...
I like easy too, so.
So this is, like, again, this is the one that a lot of people commonly use because it's just that easy. There's no need to have to rely on knowing what the book value is. There's no need to have to rely on how many units you produced that year. It's a straightforward number, right? Just like a graph. If it's going in a straight line, you can expect that you can predict the next thing, right? Because it's going to be constant. All right, so here, what is my journal going to look like for the first year?
You'll start with the depreciation expense,
Mhm.
and then accumulated depreciation, and it will be for 2,500.
Excellent. What about for the second year?
It'll remain the same.
Good. So in this case, it also makes it easier to journalize as well, because every year the journal is going to look the same, identical. Okay? Because you're depreciating for the same exact expense every year, then boom. Then every journal that you do, at the end of every single year, your journal will look identical. Okay? Okay. So now, what happens when we come into, when we place our asset into service later on in the day or later on in the year? So this example here is that we bought a machine, right? That's $10,000 with a salvage useful life of 5 years, and it should have a salvage value of $2,500 at the end of its life. Okay, but this time we placed it in service as of October 18. So record the depreciation for this. So in this case, I have my information. So if I placed it in service as of October 18, when do I actually start depreciating? Assuming that you do depreciation at the end of every year.
It started for October.
Okay, let's look at the number again. October
Would it
18.
be November since it's the 18th?
November.
It's after the 15th. Okay.
Correct, right? So in this case, we only depreciate for the month of November and December. Only 2 months. My asset is only 2 months old. Okay? So now let's go ahead and actually figure out the calculations here, because now we have to consider my asset is only 2 months old. So let's go ahead and just go through the scenario. So what's my depreciation basis going to be?
7,500.
7,500, right? We take the asset cost minus salvage, which gives you 10,000 minus 2,500. So that gives you 750. All right. What's my rate going to be?
20%.
20%. So therefore, my first year's depreciation expense is what?
It would be 1,500.
Okay. So that's just for the first year. Now, once again, this is how much I'm going to depreciate for the whole year. How old is my asset?
Only a couple months.
It's only 2 months old. So in this case, can I depreciate it for 1,500?
No.
No. So in this case, once again, we're going to visit that whole idea where we can't accept 1,500. We have to figure out how much is it going to be if it's just only 2 months old. So in this case, you can do it this way, right? You can use a decimal if you like, but I do recommend you use a fraction because of how, if we were to type this in, right? How many sixes do you need to add here to get the correct answer? Probably a lot. So in this case, best way that you can do this is you take the 1,500, right? You think about how old is the asset. It's 2 months old, right? And then you're going to divide the whole thing by 12, and you should get $250. Okay? Or in other ways, if you want to actually look at this on a more grander scale, right? You could think about taking that 1,500. How much is it going to cost? How much is it going to be if you had to split this in monthly payments? Right? You would take the 1,500 and you would divide it by 12, right? And then the next step after that is, how many months have you used already? You used 2. So you multiply it by 2 and you should get roughly the same answer, 250. Okay? All right. And then now that we have that out of the way, then therefore the accumulated depreciation is going to be 250, etc., etc. But at least we know this. We already solved for what happens when it is 1 full year, right? It's 1,500. So therefore, the journals after that, or the depreciation after that, is going to reflect as 1,500. So same thing here. What's my journal going to look like for the first year?
250.
250 depreciation expense and accumulated depreciation. All right. Any questions? So
I have a question.
Go for it.
It's just something that's in my mind. Now, for this example, for the second year, we would rate it for the full year, correct?
Correct. Because
Okay, so
if you place it into the asset into service as of November, right? What happens when it becomes January? You're gonna
it's only 2 months, right?
right.
So this would be just okay. Here, I guess here's what I'm asking. Okay, so this would be for the first year because it's only 2 months. Every journal entry after that, though, would be for a full year. So your depreciation expense for this year wouldn't be the same as next year, correct?
No, it would not be the same, just because the little notion that because of when you placed it into service. Okay, but if you had it starting as of January, then you can assume that the next 5 years the journal is going to be the same.
Right. But this would be the only instance where you'd have one different journal entry at the beginning, and then all your other years would be the same, correct?
Correct.
Okay.
Yes. Okay. Any other questions?
No.
All right, well, that's straight line for you. See, told you. Go through it pretty quick. Okay. So now I'm going to go ahead and let's put straight line off aside for just a second because amortization is going to be more or less identical to straight line. Now let's go ahead and talk about what amortization is and what it does. Okay, so chapter 11.4. So what is amortization? Okay, amortization is just another fancy word to say that I'm going to depreciate my intangible assets. Okay, so similar to what I was talking about earlier, right? If you guys remember back then on Monday when I talked about depreciating land, we can't ever depreciate land, but we can deplete the land. Okay. Now, again, this is definitely important that you know. You can't say I'm going to amortize my fixed assets because technically that's an incorrect way of saying it. But in terminology, amortization, depletion, depreciation, they all mean the same thing. You're just going to find a way to expense the item as if you used the item. So same thing here for amortization. Except for amortization, the key factor here is that we only do it to intangible assets. So once again, what is an intangible asset? Something that you can't touch. So give me an example.
Copyright.
Copyright, licenses, patents, trademarks, contracts, anything that has some kind of invisible form, but yet the only proof of it is through a piece of paper. Okay? Now, of course, you can tear up a copyright, right, by ripping up the paper, but essentially, can you get rid of that invisible force? No, you can't. So anything that's going to be considered intangible will be those type of assets, right? You have ownership over it, right? If you have a copyright, you own the rights to it until it expires. So here's one notion that you should also think about. Because it has that typical idea that it can't be touched and you have ownership over it, that means it does have an expiration date. Okay? Copyrights don't last forever, right? You always have to renew the license or you always have to renew the copyright. Just right? Just like Netflix, right? They have to pay a lot of licenses and copyright rights to all of the major filming industry companies because they need to have permission to view the movie on their online website. So think about that. So if they have to renew that every year, right, it's very important that a company is aware of that and typically keeps track of that. Now, of course, with that idea that it has a life to it, right, in this class, we're just going to assume that 15 years is probably a good general number to use, okay? I'm not going to require you to know many because, of course, every copyright, every license, every patent, every trademark has their own typical lifespan, right? Especially if it's like if you're trying to patent an idea, right? If your idea isn't very strong, you can expect that the shortest life that you can purchase it for would probably be anywhere from a year to 3 years. So especially when a person who's trying to purchase the patent wants to protect this idea, right? They do have the choice when they go into legal, when they sign the legal contract for that, they can determine how long they want to pay for the protection over that idea is for. So the same thing with copyrights and licenses, right? Disney, they own everything, right? But they have to update their patents and license and stuff. However, they also let other companies pay into their licenses to have permission to either use their logo, etc., whatever it is, right? So you can guarantee that they probably have a long lifespan on it, right? anywhere from 20 to 25 years or even 30 years patents or license or copyright licenses for those. Okay, so it really depends on how big the company is, or if they see or they deem that it needs to be protected for a long time, then or how valuable that asset is going to be determined on what estimated life that it should have. Now, once again, a patent, right, expires and you have to renew it. So therefore, it can never have a residual or salvage value because it expires and you have to renew it. So that's one key factor or key component that you will not have when you're doing amortization, because you can't hold a value on it, right? The value is determined on how much you are, planning to protect it for, okay? And it expires. So that's one component that you don't have to worry about. However, they're going to be, when you're looking into a patent or a copyright, right, you are going to follow the exact way or the exact method as straight line. Okay? You're going to amortize it by following the exact instructions for straight line. The only difference is you don't have a salvage value. So right away, you're good to go, because then your base is just your asset cost. All right. And once again, for this class, I just want you to just know 15 years. Okay. So let's go ahead, and here's the formula this time. So once again, because there's no salvage value, we don't care, right? We don't care to keep that as part of it. So here, my depreciation basis, or in this case, amortization basis, is going to be just the asset cost. My rate is going to be my 1 over the estimated useful life. And then, of course, basis times rate. And then, of course, these two are going to stay the same, especially when you're doing accumulated amortization. Same idea. Okay. And of course, book value, same idea. It's your asset cost minus your accumulated. So once again, it's identical to straight line, except you just don't have one component, and that's just a salvage value. You are expected that you're going to amortize it all the way to 0 because it has an expiration date, right? There's no salvage value or life at the end of it, right? Every time you renew it, then you have a brand new life, and then you're going to have to start all over, okay? So let's go ahead and dive into the example here, okay? We purchased, we purchased a patent, okay, for the protection of the idea, right? That's what a patent is. And we decided that it cost you $20,000 to put a patent on this idea, okay? Once again, the useful estimated use of life is 15 years, and the date that you place it into service is going to be January 5th. In this case, right, if we're following the same rules as straight line, the one thing that you need to know is when you purchase your patents, the day that you pay for it is the day that you place into service, because the protection should be effective immediately. So therefore, the date that you use it is going to be the same as the date that you purchased it, because once you pay for it, boom, it's automatically protected. Okay. So at least for here, you're going to be using the same concept. If it falls between the 1st and the 15th, then you're going to amortize it for that month. If it falls after the 16th through the 31st, then you will depreciate it or amortize it the following month. So same idea applies here as well. But when you are thinking about the day that you place it into service, it's going to be the day that you purchase it. Okay. So once again, let's take a look at this. Assuming that we amortized at the end of the year and we placed it into service as of January 5th, or we bought it on January 5th. Therefore, let's go ahead and go through each and every single one. What's my basis going to be?
20,000.
20,000, right? It's going to be the same thing as your asset cost, okay? What is going to be my rate?
0.07.
1/15.
I think it's 666. Yeah, 0.66667.
Okay.
Yeah.
Okay, so yes, because this is 1/15. The other one's 1/, what did you say? 0.15. There should be probably 1/7. Okay.
I said 1/15.
I rounded up to 0.07 just because of the 6, but yeah.
No, that's completely fine. But remember, if you're going to keep that number in here, you may be off by a couple pennies.
Okay.
So then what is going to be my depreciation expense here?
$1,333.40.
Okay, so that's where you rounded, right? Because you didn't do how many enough sixes. So once again, same thing here. So it's roughly $1,333.33. Okay. So then what's my accumulated depreciation? Same thing as my depreciation expense for the first year. So then therefore, what is going to be my book value?
$18,666.67.
Excellent. So once again, if this is going to follow the same exact rules as straight line, you can expect that the next year and the year after that is going to be the same. Oops, so next year is going to be the same, right? As long as you solve for the first one and you know it's for a whole year, amortization for the second year is going to be the same. It's going to be the 20,000 at the 0.076667 for the $1,333.33. Therefore, the only numbers that you're really truly calculating is your total amortization, accumulated amortization, and the book value. Okay, but we already know if you can solve for one, if it's for the whole year, solve for one, you have the rest of the answers. Okay, so you're going to be computing this for the next 15 years because that's the life and that's the span of the entire asset. Okay. Any questions? So just now, how do we journalize it?
Depreciation expense, accumulated depreciation.
Now, once again, can you use the word depreciation?
Oh, no.
Amortization.
Yes. So same exact, except you need to just swap out the words. So instead of depreciation, it's amortization. Okay. So amortization expense and accumulated amortization for the 1,033.33. And once again, because it's following the same exact rules as straight line, every year the amortization journal will look identical. Okay. Any questions? So chapter review, right? We got to take a look at straight line, and because amortization is identical except for that one component that we don't have, which is the salvage value, that's why I taught this together, because if amortization is similar to straight line, if I teach you one, you should be able to do the other, right? So once again, the difference between the methods, right? Straight line is literally spreading the asset cost amongst the total lifespan. So in this case, if there's 5 years, you're going to divide the asset cost minus the salvage value and divide the whole thing by 5, and you would get every single year of how much to depreciate, okay? Because you're depreciating it evenly throughout its life. Same thing here with amortization. The only key thing that you need to know is that it's for intangible assets and intangible assets only. And it's going to be identical to straight line. And there is no salvage value because, the idea of an intangible asset is that it has an expiration date. After it's used up and gone, it's gone until you renew it and then add a new price value for it. Okay. Any questions in regards to chapter 11.3 and 11.4? Okay.
I don't think so.
All right. Like I said, it's the easiest one, and if you know how to use Excel, you could be done in 5 minutes. So let's go ahead and dive right into the chapter 11.3 and 11.4 exercises. Okay. So question number 1. All right. So here, I made this a little too big, so let me zoom out. Okay. So question number 1 says that you purchase a coffee maker for $250 with no salvage value, okay? Its useful life is 5 years, okay? And it could produce up to 2,000 or 25,000 pots, okay? So it's a good coffee maker. And then, so you decided that you wanted to place this coffee maker into service as of January 12th. So, assuming that you are depreciating for the year as of December 31st, okay, let's go ahead and fill out in our table. What did we buy?
Coffee pot.
Coffee maker, yes. All right. How much was the coffee maker worth? How much was the cost of the coffee maker?
$250.
$250. Right?
No salvage.
And no salvage value. Good. Okay. What's the estimated useful life?
5 years.
5 years. Okay. And lastly, what's the date that we placed into service?
January 12th.
January 12th. So what does that tell us?
You get the whole year.
We get the whole year. That means we need to depreciate for the month of January all the way to December. So we get the whole year. Excellent. So let's go ahead and fill out our table. Okay. What's my depreciation basis going to be?
250.
250, right? We take the 250 minus my salvage value, which we know is 0. So therefore, it's 250. And what do we know? If we solve for 1, what happens? They're all going to be the same. They're all going to be the same because even if I ask you, what's the depreciation basis for year 2? It's the asset cost minus salvage value. Identical. Okay. What about the rate? What's my rate going to be?
20%.
1 divided by 5, right? The estimated useful life gives you 20%. And what do we know about this 20%?
It'll remain the same.
It will remain the same, right? Boom. Use the autofill tool, okay? So therefore, what is going to be my depreciation expense?
$50.
$50, right? Okay. So therefore, what is going to be my accumulated depreciation?
$50.
$50. So therefore, what is going to be my book value as of year 1?
200.
I have to do the absolute value here. So 250 minus 50. I did it again. 250. Okay, absolute minus the 50. Okay, and we get $200. Okay. All right, everyone okay here? So then, if that's the case, if my depreciation expense for the year 1 is $50, then what's my depreciation expense for year 2?
$50.
Again, it's your basis times your rate, which in this case, if my basis and my rate stay the same, Therefore, if I were to go ahead and multiply these across, I still get the same number. So here we can assume that these are all going to be the same. Okay? So therefore, now all I have to do is just start calculating my accumulated depreciation and my book value. So here, what is my accumulated depreciation for the second year?
$100.
Right? 50 plus 50 is 100. Therefore, what is going to be my book value?
150.
150. Right? Same thing now, right? This is pretty easy math, right? Anybody, so what's 100 plus 50?
150.
150, which is my accumulated depreciation for the third year. Therefore, what's my book value going to be?
100.
It's going to be 100, right? What about my accumulated depreciation for year 4?
200.
200. Therefore, that makes my book value what?
50.
50. Last but not least, what is my accumulated depreciation for the 5th year?
250.
Therefore, my book value is what? 0.
Settle.
That's it. That's all you have to do. And seeing if you know how to use Excel, it's pretty straightforward, right? Even if you wanted to do this on pen and paper, it's so easy, right? If you already solved for the first two, at least for the first two, you should be able to solve for the rest. It's pretty straightforward, right? My depreciation basis and my rate should stay the same. Same thing with my expense. These 3 columns should be quick to fill. The only calculation I'm really doing here is just to calculate my accumulated depreciation and my book value. Which in this case, I used very, very easy numbers, right? 50 plus 50 is 100, right? 100 plus 50 is 150. 150 plus 50 is 200, right? Easy, 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 easy numbers. And watch, we looked at our book value. Every year that we depreciate it, we could slowly see that it's declining in value and that now my book value should remain at 0, okay, which my salvage value is 0. So therefore, I met my criteria, okay? So then, question number 2 and question number 3 says, what is my journal going to look like for the first year of depreciation? So assuming this is December 31st, what is my journal going to look like?
The depreciation expense.
So depreciate. Okay, and what else?
Accumulated depreciation.
Would we,
For what? What was that, Nicole?
oh, no, nothing, sorry.
Okay. How much is it going to be for the first year?
$50.
It's going to be $50. Okay. So then, what is going to be my journal for year 2 of depreciation?
Same.
It's going to look identical. So in this case, I can simply just copy that over. Obviously, when you're dealing with your books, you're not going to be looking at like a span of 5 years. So in this case, that's just what the idea is, that for the second year, it should look identical to the first year. Okay. Good. Easy?
Yes.
Okay. So now let's go ahead and move on a little harder. Okay, so question number 4. Okay. So let's take a look at this example here. All right, so in this example, I decided that you purchase a couch for $2,485, okay, which includes all fees and shipping, whatever, okay? It's all included. Now it asks you, okay, with a salvage value of $150. It's a couch, of course, it should hold some sort of value. All right, and then of course, its estimated useful life is 7 years. So remember, furniture is typically going to last quite a long time. So usually the Blue Kelly book, like I've mentioned before, should last about maybe 7 years, okay? Give or take, 7 years, okay? Depending on how often you use it. Now in this case, I am going to place this in service as of August 25th, okay? Assume that the adjustments are made every single month. Okay? So let's go ahead and take a look at this. So, assets. What did I buy?
Couch.
You bought a couch. Okay. Let's see. What was the cost of the couch?
$24.85.
$24,085. What's the salvage value?
150.
On Craigslist.
150, yes. Okay. All right. What's the estimated useful life?
7 years.
7 years. Okay. And then, of course, therefore, what date did I place this into service?
August 25th.
August 25th. So, let's talk about the first month. Okay. So, in this case, right, what would technically be my first month?
September.
September. Okay. Excellent. So, let's go ahead and solve for the table first, and then we'll go ahead and go for it. So, on September, what is going to be my depreciation basis?
$23.35.
$23.35. So here we decided to take the cost of the asset, which is the $24.85, and we're going to subtract out the salvage value of $150 to equal $23.35. Okay. What is going to be my rate?
0.14285714.
Perfect. So that's going to be 1 divided by my useful estimated life of 7 years. So that does give you the 0.1428, like that, okay? So it's not a nice number, okay? So therefore, I should recommend you to utilize your equal round, okay? I've done this many times. You will get off a penny if you do not use your equal round, okay?
And that one, for the rate, we're not going to use the absolute numbers, right?
The rate, I just typed in 1 divided by 7.
Yeah, but we're not using, oh, okay.
I just typed it in. So for this right, you don't have to necessarily use the cell references. Okay,
Right.
you could type everything in. Okay. But usually when you want to maximize the use of and the capabilities of Excel, I don't want to have to type in that every single time. So to save me some time, I'm just going to cell reference and do absolute so I can use the fill handle tool. All right, so then here, what is going to be my depreciation expense for the first month?
300.
$27.80.
All right, so I got 2 numbers. Okay, so Felipe, what did you say?
I got 333. Oh, yeah, I'm sorry. I did the whole year. Alan's correct.
So Alan, what did you get?
$27.80.
$27.80. Okay, so all right, so let's go ahead and take a look at this. So I'm going to go ahead and just solve for the year first so I can kind of see what I am actually dealing with. So in this case, if I were to take my depreciation basis times my rate, I should roughly get $333.57, right? Is that what you got, Felipe?
Of course I did, but that not
Yeah,
take
so
into
did I.
consideration when we put
Exactly.
in service.
Okay. Now, okay, you're thinking that way. Okay, so if I were to follow my place that I went into service, what did you do here?
Me or Alan?
I'm talking to you, Felipe, yes. Felipe.
Oh no, I was just thinking again. That's the whole year. We only had it in service for 3 months, not the complete year. So
Okay.
what would I do?
Mm-hmm.
Complete honesty, I'm gonna go divide that by 12 and then multiply it by 3.
Okay. Now, the assumption here, so this is where you have to read carefully. Am I asking you to depreciate it for the year?
No, no.
What am I asking you to depreciate as?
For the 3 months that was in service.
Did I say 3 months? Now, let's read that thing again.
Man, you're gonna make me look up a calendar.
Felipe, no. Don't look up anything. I just need
Okay.
you to read this exact line right here. Assume that the adjustments are made at the end of...
Each month. Oh. Okay. Let me read through the math then. Yes.
So,
then I would take the 33, 30, and 57 cents and divide that by 12.
exactly. And that's the easiest thing I'm just asking you to do is just, once you get the full year, and I'm asking you to depreciate it every month, your assumption is, okay, that means I'm just going to divide it by 12 because there's 12 months in a year. So in this case, my depreciation expense is in fact going to stay the same because I'm doing it every month. Whenever I place into service doesn't matter to me because I'm doing it every month anyway. So I'm not depreciating it for the year. So in this case, it is time sensitive because obviously you need to know which month you're going to be depreciating it. But in this case, I'm doing it every month. And if I need to know that, then it's straightforward, right? If I can calculate for the whole amount for 1 year, how much is it going to be for every single month? You just simply divide it evenly every single month. How do you make a monthly payment? That's exactly what we're talking about right here. If your whole year is going to consist of $333, what is your monthly payment? You're going to just simply take this number and divide it by 12. And that's it. So here, this is a trick question, but it's also something that we will take a look into because we have the option. You can depreciate it either as an annual thing or you can depreciate it every single month. Okay?
So we would divide the 333 by 12?
Yes, and that's it. Because I'm not asking you for the year. I'm asking you for the month.
So it'd be 2780.
Yes. So in this case, I'm going to do my equal round once again because this is a very nasty number and I want to make sure I have clean numbers. So you're going to take this and your basis times your rate and you're simply going to divide the whole thing by 12 to get your monthly depreciation. Okay? So yes, it is $27.80. Okay? So once again, what's my accumulated depreciation? Mm-hmm. And therefore, what is going to be my book value?
$2,307.20.
Okay.
457.20.
So,
Wait, how did the price go up?
did you add?
No, I got minus. You got 24. I got 23.
$24.85 minus $27.
My fault. No, I was going on the base. Oh, my fault.
Okay, yes, remember, it's never the basis, it's always the asset cost.
Okay.
Mm-hmm. So there you go. There's for the first month. So then let's go ahead and solve for month number 2. What's my depreciation basis going to be? Exactly. In this case, this also follows the same law, right? That I'm just going to depreciate it for the same, or my basis is going to always stay the same, whether it's a monthly thing or whether it's a yearly thing. That's your start of what you're going to be looking at, okay? And then my rate.
2780.
Okay, my rate.
I meant it's going to stay the same.
Yes, it's all going to stay the same. Correct, right? So let's go ahead and do that math again. What is my depreciation basis times the rate divided by 12? What's my monthly depreciation going to be? It will stay the same. Yes, because if you calculate it, go ahead and calculate it. You're still going to get the same answer. So in this case, it will stay all the same. You're going to depreciate it every single month, $27.80. So the only difference here is that now we just have to calculate our accumulated depreciation. So once again, this right here, it doesn't matter when I started, but make sure that you do have the total amount of months, because once again, we have to consider when did you place into service. So therefore, if you start the age at September, right? How many months do you need to keep doing this for? Okay, so if there's 12 months and it can last how many years? 7 years. 12 times 7 is 84. So therefore, you have to be doing this for 84 months to get to your value at the 150 for salvage value. Okay. So then let's go ahead and let's fill out the rest of my table then. Okay. What's my accumulated? 57 what? 50? 60? Good. Okay. Therefore, what's your book value going to be?
24.29 and 40 cents.
Good. What's the accumulated depreciation for the third year?
83.40.
83.40. So therefore, my book value will be
24.01 and 60 cents.
24.0160. Perfect. Accumulated depreciation for the fourth year?
Would that be the fourth month, not the year?
Oh, yeah. Yeah, you got me.
Oh my God.
All right. Okay. Yes. Fourth month. Yes. Correct.
111.20.
111.20. So my book value at the end of the fourth month is going to be
23.73 and 80 cents.
okay. So in this case, what is it? September, October, November, December. Okay. So now we're on the month of January. So what's my accumulated depreciation as of January?
139.
So then my book value as of January will be
23.46.
23.46 even. Good. My accumulated depreciation for the sixth month.
166.8.
Book value.
23.822.
And then last but not least, for the seventh month, what's my accumulated depreciation going to be?
194.60 190 cents.
190.
4 and 60 cents.
60 cents. Okay, good. Good. And lastly, what's my book value? 22.90 and 40 cents. See? Once again, once you understand how to use Excel, you can, like I said, you can fill this sheet almost out in 5 minutes. Now, if you're doing this by pen and paper, it's straightforward too. If you already solved for the first 3 columns, all you have to do is just make sure that you add your numbers accordingly, right? And since you know that this number is going to be the same, it's the same thing as you doing multiplication, right? 27, was that 27? Oh, wait, 2780 plus 2780, 5580 plus 2780, right? That part's going to be pretty straightforward, okay? And of course, your book value, right? As long as you know the component here, which is what your asset cost is, you simply are just going to subtract out whatever your accumulated depreciation was. And this is, as far as doing the calculations, that this would be the most that you would do when you're dealing with straight line, okay? Good. Any questions? Okay.
No.
Let's take a look. Question number 5. All right. So we're going to record the adjustment entry for the month of August. Okay, for the first year. So how am I going to record this for August 31st?
Depreciation expense?
No.
Amortization expense.
No. Okay, let's read this carefully. I'm going to journalize my entry as of August. Okay, August for the first year. When did I depreciate my asset or start depreciating my asset?
September.
So what should my journal look like in August?
Well, there is no journal.
Nothing.
Correct. There's nothing there because you didn't depreciate it for August. You depreciate it for the month of September. So in this case, no entry. So once again, I'm testing you this because this is reality, right? You'll come to a time where you will see this happen, right? You do not need to do a journal entry for the month of August. However, let's read question number 6. Record the adjustment entry for the month of September for the first year. So in this case, now what is my journal for September?
Well, would there be an entry if we do it at the end of the year?
In this case, I'm doing monthly adjustments. So the question is,
Would it be the depreciation?
yes.
Okay.
Because I'm doing it every month, right? Okay, so here for the month of September for the first year, right? My depreciation expense, and what is the accumulated depreciation? So what is my value here? What am I going to journalize?
2780.
2780. Okay. Good. Now let's go ahead and answer the next question here. Okay. Now it says here, okay, okay, record the adjustment entry for the first year, assuming that depreciation adjustments were done at the end of the year of December 31st, okay? So what would it be if instead of doing every month, right, what would be if I calculate it for the year? Okay.
Would be 8340.
8340. How did you get that?
I times the 2780 times the 3 months.
September, October, November, December?
Or 4.
The 4 months.
4 months.
You need 4 months, yes. So in this case, yes. Excellent. So in this case, since you've already calculated what it was for the month, right? You can just simply add, or let's take a look at my cumulative depreciation, right? If I were to just go ahead, 1, 2, 3, 4, right? Then my depreciation expense for 4 months would be the $111.20, right? That's the 2780 times 4, which gives you 111.20. So in this case, that will be if I decided to switch my adjustments from monthly to annually. If I do it at the end of the year, that's what my depreciation would look like. Is that if I were to depreciate it for the end of the year, it would look like that. Okay, so if the adjustments were done at the end of the year, it'd be 120. Okay, so once again, reading the details is very crucial in making sure that you are aware of what you're doing, and look at it very carefully, because if I'm going to ask you to depreciate it for every month, then you need to make sure that you calculate your depreciation expense based on the month. If I ask you for the year, which we've seen majority of the examples for the year, you're going to have to consider how much it is for that year, plus how old is it for the first year. Okay, so since we've been practicing that partial years thing for the double declining, so this one I want you to take a look at what if I just did it for every single month. Okay, good. Any questions so far?
No, but I did this 2 different ways as far as with the rate.
Okay.
And using the equal round, I came up with the exact same figures. What I did was on my second, I did for the rate, I did the 1 divided by 7 times the 1 divided by 12 to get 0.01. And like I said, I did the equal round in the depreciation expense formula like I did above, and I got the same exact answer, and I was just curious last night if it would come out the same, and it did.
Yes, it would absolutely do it, because when we're looking at this, right, this is as a whole, what do you call it? This is for the whole year. So whether you do the rate divided by the months, or whether you take the depreciation divided by the months, essentially you're doing the same thing. But in this case, the best way to do it is that, you know, as a standpoint, or just instead of doing it that way, instead of making it more confusing for yourself by saying the rate needs to be divided by 12, then you can also think about it this way. If you can solve for the total amount of depreciation for the whole year, think of it, how are you going to make your monthly payments if you had to meet that criteria, right? You just simply take your expense and divide it by 12. Now, again, and I think in the very, very, very beginning, that's exactly how Felipe did it. He just divided the rate to solve for the depreciation expense. You can do that. That's absolutely correct. And it will lead you to the same exact answer as well. Okay. So good. Yes. Once again, if you guys remember from way back when I started talking about accounting from the beginning of the course, right? It doesn't matter how many ways you can get to the answer, as long as you get the answer. And that's the beauty of accounting. There's always an answer. There's just so many pathways that you can take to get to it. All right? So that's straight line for you. Last question that we have here is, of course, an amortization example. So here, once again, question number 8 says that as of January 12th, you decide to purchase a copyright for $2,500. Its useful life is 15 years. So, therefore, what are my components? What did I buy?
Copyright.
You bought a copyright. Okay. Oops. Okay, no, that's right. Copyright. How much did it cost me?
$2,500.
Yes. Okay. And of course, does it have a salvage value?
No.
No. So that's why I didn't have that included in one of the criteria. What's its useful life?
15 years.
15 years. And lastly, when did I actually place this into service, or when did it start?
January 12th.
January 12th. So therefore, assuming that I amortize this every year as of December 31st, when do I actually start to amortizing?
January 1st.
January 1st. So in this case, because we are doing similar to straight line, because there's 15 years, I'm only going to just have you guys do the first 5. So what's going to be my depreciation basis?
The 2,500.
2,500. Okay. What is going to be my rate?
0.06666667.
Yes, right? It's that long, complicated number. Okay. So therefore, I should recommend you that you do utilize your equal round, just so then if you are cell referencing, it doesn't change certain areas because you will be off by a couple pennies. So in this case, equal round. So what is going to be my depreciation expense, or in this case, amortization expense for the year, for the first year?
6.67.
Do we stop at 6.7 or just keep going with the 6s?
For what, the rate or the expense?
Depreciation expense.
Okay, so the depreciation expense, right? This number is something that you're going to journalize.
Oh, crap.
What's the rule of journalizing?
Round up.
Always round up. Good. So in this case, it's 166.67. Okay. Always round up. Yes?
I messed up on my rate, I believe. So
Okay.
1 divided by the 15, right?
Mm-hmm.
For the expense.
Mm-hmm.
And that's the 2,500 times the 0.0666, right?
Mm-hmm.
Okay, I'm with you.
Okay. So therefore, what should be my accumulated depreciation for the first year? Mm-hmm. So therefore, what should be my book value at the end of year 1?
33 and 33 cents.
Good. Okay. So now that we have our first number here, what's going to be my depreciation basis for year 2?
So wouldn't the first 3 rows still be the same?
Correct. So in this case, since Nicole has recognized that, right? If you know how to, you could go ahead and pull this formula all the way down. This is the absolute cell reference, so make sure you have that. This is just a regular number I typed in, so this should also be the same. And of course, we recognize that if you had the formula to multiply these two together, right? It should, by you pulling the formula all the way down, it should pick up the numbers associated in that row. Okay? So there you go. They're all going to be the same. The only thing that we're going to be calculating is the accumulated amortization for every year. So in this case, what is my accumulated amortization for year 2?
$333.34.
Okay, hold on. I got to clear it out. There you go. 333 and 30. 34, because 7 plus 7 is 14. Okay. So therefore, what is going to be your book value?
21.66 and 66 cents.
Good. Right. What about the accumulated amortization for year 3?
501.
And 1 cent.
Yeah.
Because 4 plus 7 is equal to 11, so therefore you need to have that 1 penny. So then your book value is going to be
1,999 and 99 cents.
good. All right. Let's keep going. What is the accumulated amortization for year 4?
666.68.
Yes, good. Okay, right? If you add 1 plus 7, that should give you 8 cents. Okay. And then what is my book value for year 4?
1830 32 cents.
Excellent. Last but not least, what is my accumulated amortization for year 5?
833.35.
Good. Therefore, my book value for year 5 is
16666 and 55 cents.
good.
Oh, I'm gonna sip somewhere.
Okay, no worries. All right, see? Easy peasy lemon squeezy, okay? The easiest type of depreciation method, and it's the widely used one, okay? All right, so now last 2 questions is we're going to amortize for the first and the second year. So what should my journal look like at the end of the first year?
Would be the amortization expense and accumulated amortization.
All right, for how much?
16667.
Okay, and therefore that holds the same thing too. What about for year 2? What is my journal going to look like for year 2?
Exact same like did last year.
Correct. It's going to look identical. Okay. All right. So any questions in regards to doing straight line and amortization? Once again, it's the easiest one. All you need to do is be able to solve for 1 in most cases, right? Unless you have placed it into service later on in its life. But this is a perfect example of taking a look at the circumstances, right? If I'm doing it as an annual adjustment, or am I doing it at the end of the month? Okay, so there you have it. Okay, and perfect. It is just enough time to call for break. Any other questions?